Good morning. How much house should you really buy? Well, the short answer is less than the bank says you can. And as a mortgage broker at Medallion Funds, I see this mistake all the time. Buyers focus on getting the maximum approval amount instead of the optimal purchase price for their life goals and long term financial strategy. And getting approved and buying smart are two very different things. So let's break this down the right way. Step number one, what lenders are going to actually calculate. So most buyers think the approval number equals what they should spend, whereas lenders are going to calculate what your debt to income ratio is, and that determines your approval amount. But also your credit score and income stability and your personal assets and reserves will also play into that number. And for conventional loans, lenders may approve you for between 43 and 50% of your total debt to income ratio, and sometimes higher with strong compensating factors. But essentially, that means nearly half your gross monthly income could go towards new debt. And that's approval math, not lifestyle math. Step number two, the real risk, becoming house poor. And being house poor is not fun because I've lived it, but your payment consumes most of your income and you have limited liquidity the whole time. And it limits what you can invest, save, or handle emergencies with comfortably. So your mortgage payment isn't just principal and interest. It also includes your property taxes, your homeowner's insurance, your HOA dues, and monthly maintenance that you need to budget in for about 1-2% of your value annually, but also your utilities and future repairs. So a $600,000 home isn't just a bigger mortgage, it's bigger everything, is the point. So step number three is a smarter formula. Instead of asking, what's my max approval? Well, you may want to ask, what monthly payment keeps me comfortable? Can I still invest 15 to 20% of my monthly income? And can I maintain 6 or more months of reserves? And can I handle a temporary income disruption? And for most buyers, a housing payment between 25 to 35% of your gross income is really sustainable in the long term, even if you qualify for more. Step number four, strategic borrowing versus emotional buying. So your home is part of a financial plan, and Medallion Funds, we can help clients align their mortgage structure along with their career trajectory and their investment goals, but also their exit strategy when it's time to move on. So first time buyers often overbuy due to emotion, and move up buyers sometimes stretch based on their lifestyle inflation. So the right home should support your wealth building plan and not slow it down, is the point. Step number five, interest rates matter, but so does flexibility. And in higher rate environments like we've been in, payments stretch further, is the point. And your qualification will tighten, but your risk tolerance is going to matter more. And sometimes buying slightly below your max approval will give you faster principal reduction because you can afford to pay a little bit extra, but also a flexibility to refinance later. But then again, also the ability to invest in other rental property. And most importantly, less stress. Financial freedom is better than maximum square footage. Step number six, custom strategy matters. And every borrower is different. Self employed, cash flow analysis matters. And if you're an investor, liquidity and future leverage matter. And if you're a high income professional, tax strategy and capital deployment matter. But if you have a growing family, stability matters. So, really, the point is there's no one size fits all number. And the goal isn't how big, the goal is how sustainable and strategic is it. So, I'll leave you with the final thought for the day on determining your max approval amounts. But the bank will tell you what you can buy, and a strategic mortgage advisor helps you decide what you should buy. And if you want to run real numbers and structure your financing intentionally, we can map it out clearly, your income, your DTI reserves, and your long term plan. And that's how you avoid becoming house poor and build wealth the right way. And that, my friends, is it for the day. My name is Bill Rapp. I work for a company called Medallion Funds. I do mortgage and capital advisory. And you can visit my website, billrapponline.com, to figure out how to get a hold of me. Love to talk to you more. Take care.